Chapter 11. Accounting and Finance Functions Within Business. In this chapter, our focus is on discussing about the accounting function and the finance functions in a business, and is divided into 4 different sections. First, we will have an introduction of the accounting function, and also to talk about what items or what departments should be within the accounting function. And next is followed by the financial accounting function discussion, and then it's about the management accounting. The final part of the chapter is about treasury and taxation. So let's start with the accounting function. Accounting department is one of the important departments within a business organization. Accounting is the systematic of recording, reporting, and analysis of financial transactions within a business. In other words, accounting is about recording and prepare the financial reports to the business owners and the related stakeholders about what performance or what are the financial performance of the business. To do that, we should have a structure for accounting department in order to perform the duties and roles of the department. Here is an overall picture of the accounting department. In larger organizations, the range of tasks that the accounting function needs to perform is very wide. Here we just show a brief picture of the key accounting functions within the department. And we will start the discussion of each role one by one. First, let's go through the head of the department, which is the finance director. Finance director is the key person in accounting departments in order to monitor the functions of the department to ensure it can perform the required task as detailed in the job scope. And the major responsibility of the finance director includes such as debt equity structure. It means that the financing decision should be proposed and finalized by the finance director with the board of management. How much of the capital should be raised through debt, or how much of the capital should be raised through equity? That's the debt and equity structure. And next, financial measurement of commercial success. In order to determine whether the business is financially sound or success, financial measurement is one of the key elements to do that. And finance director is responsible on preparing the financial reports to the board of management and other stakeholders relevant to the financial performance. And then it's about resource allocation. It's not just about money, it's about the efficiency. Let's say whether we should hire the vendor for logistic arrangement, or we should use internal resources by hiring the talent in logistics to do the jobs by our own. Here is about the resource allocation. The finance director should propose the best or the most efficient way to do it in terms of monetary terms. And also the finance director is responsible for planning and acquisitions of divestments. It means that the finance director should advise the board or the CEO, the chief executive officer, on whether the proposed acquisition is financially sound, and any of the divestment should be done because of, say, improved overall efficiency or for improve the cash flow as well. Here is one of the key responsibilities for finance director in the acquisitions and divestments. Also, finance director is also responsible for dividend policy. In other words, he should advise the board of the management on how much of the profit should be retained in the organization and how much can be distributed to the shareholders. The goal is to keep the adequate resources for future expansion and development and growth, but at the same time, finance director need to consider the shareholders' return as well. Last but not the least, finance directors is also responsible for the relationship between the shareholder and the company, as well as the financial press and the company as well. And then we have 4 different subdivisions of accounting departments under finance director. The first one is the financial accounting division, which is headed by the chief accountant. Chief accountant is responsible for financial accounting and auditor relationship, and we will go through in the details for financial accounting in our following of the class. And another division under finance director is management accounting, which is headed by the management accountant. Management accountant should provide the information which is used for internal decision making. So management accountant is to provide the management information and accounting, which include the budget and forecasting, and also include the internal financial structure and control. These are 2 major works or major tasks for management accountants to do on a daily basis. He or she needs to prepare the forecast or the budget for the company, and also he or she should propose any improvement in the financial structure and controls procedures, which is aiming to have the most efficient way to do the business in the commercial operations. Sometimes management accountant need to work out the investment appraisal analysis. The management accountant will get the involvement in the capital budgeting or fixed assets financing. In other words, once a company decides to buy a fixed asset, the management accountant should advise whether this investment is financially acceptable or not acceptable. Another role under finance director, which is also in accounting department, is treasury, which is headed by the treasurer. He or she needs to help finance director to determine the debt and equity ratio. That means the treasurer needs to consider about the debt strategy for the company as a whole. Apart from it, he or she needs to work with the bank for currency management and working capital management. That means for any foreign exchange issues, the treasurer needs to propose to the finance directors on whether the foreign exchange should be managed by different hedging tools, for example, in order to minimize the foreign exchange rate risk. And also the treasurer needs to work on the working capital management. Here is about the operations, to see whether the operations can generate the positive operating cash flow. Treasurer needs to work closely with different departments on the working capital management. For example, he or she needs to consider whether the account receivables is too high or is too large for the company to work. If yes, treasurer needs to propose any alternatives to solve the large account receivables situations in order to improve the overall liquidity of the company. For here, treasurer needs to work on investment appraisal. Once the management accountant work out the investment appraisal by showing whether it is financially acceptable, treasurer needs to work closely with the management accountant about the source of finance for the investment. It's also about the debt strategy and equity strategy. In order to improve the investment return of a project, treasurer need to propose the most acceptable or the best capital structure on financing the investment. And then treasurer needs to work with bank in the banking forecasting and also the risk management. It's not just the banking relationship. The treasurer needs to work closely with the bank to ensure the company enjoys the most favorable interest rate as well as the most favorable foreign exchange rate with the bank. The last function under the accounting department is taxation. It's headed by the tax manager. Tax manager needs to do the tax strategy or tax planning in order to minimize the tax. There should not be any tax avoidance or evasion, but the tax manager should use all possible tools and planning to mitigate the tax impact for the company. Apart from the tax planning and strategy, tax manager need to ensure all commercial activities within the company should comply with the tax law. And next, we will go through each department step by step, one by one. The first department that I would like to share and go through with you is the financial accounting function. Financial accounting function or financial accounting is concerned with the production of annual financial statements in accordance with the relevant accounting standards and legislation. There are three main financial statements produced by most businesses each year. Whenever a business transaction takes place, there is a need to record the transaction in the organization's accounting records. Right now, accounting records are likely to be maintained on a computerized and integrated system. And here are the most popular financial statements you can find in the financial accounting or accounting records or accounting systems. We have three financial statements. The first one is the statement of profit and loss, or SOPL, also known as profit and loss account for the year. It is about the profit or loss status of a company on each month or for the whole period in a particular year. It covers the months, for example, like from January to December of a particular year. And next, the second statement is statement of financial position as at the year end. It's sometimes known as SOFP, statement of financial position. In the past, it's called balance sheet. It is a snapshot of the financial status of a company at a particular point of time. For example, at the year end, which is on the 31st of December. At 31st of December, what is the cash balances that the company has? Then you can find the numbers in the statement of financial position. Or you would like to know how much of the liabilities as at 31st of December. You also need to check with the balance sheet or the statement of financial position. It is a snapshot. It cannot show you the flow or the movement in the year. That means you don't know the liabilities for any particular period in the statement, because it's only showed you one day or only 1 second, only the 1 second snapshot at a particular time. Another main financial statement is statement of cash or statement of cash flows for the year. Remember, here is also covering a period of time. It's about for the year. It can show you what are the accumulative activities generated in the year for the cash flows. These three main financial statements, you need to remember two of them. That is the profit and loss account here, and also the statement of cash flow for the year, are demonstrating the accumulative activities or financial activities performance for a company or for an organization. But for the statement of financial position here, I mark it as a star. The statement of financial position as at the year end means It only shows the one-time status or one-time snapshot of a particular company's financial status or conditions. So let's see each financial statement's key features. For statement of profit or loss, it details the income as well as the cost incurred in the period. So here is covering a period of time for both income and cost. This allows the business to calculate whether it has made a profit or a loss. So what we also call it profit and loss account, because the stakeholders or the reader can have an idea of whether the company is making a profit or a loss in a particular period of time. Statement of financial position as at the year end means or shows the assets like business resources, motor vehicles, buildings and cash, and also the liabilities such as bank loans or the accounts payable to suppliers of the business. And this statement also shows the stake that the owners of the business have in the organization through reading numbers in the capital. In a company, this is often referred to as shareholders' equity. It means that for the capital stated in the company, we also call it shareholders' equity because it's contributed by the shareholders at the beginning of the day or through other financing arrangements. Statements of cash flows for the year. It summarizes the cash receipts and payments for the year. It also covers a period of time. This helps to show whether the company is solvent and where the cash has been spent in the year. It is very important for the business owners or the entrepreneurs know how the cash flow status of the company, because you can check the cash balance through the balance sheet, and you can have an idea of how the business performed through the profit and loss account about whether it's making profit or not. But you don't know whether your company have adequate cash for settlement of liabilities or to meet the bank's obligations on the bank borrowings. So you have to check the statements, or you have to prepare the statement of cash flow for the year in order to understand it well and to ensure the company is still solvent. That means it can run the business without any interruption of funds shortage. The main reason of preparing financial statements is to satisfy groups of people who have an interest in the financial performance of the business. So why do we have the financial statements prepared? Because we need to satisfy some of the key stakeholders of the company. And they include these 6 different types of groups. Owners, that means the business owners, the managers, also the banks, employees, suppliers and customers, and government. And now we see why of these stakeholders are interested in the financial statements prepared by the company. For the owners, they are interested in how profitable the business is and how well it is being run. Therefore, the business owners, no matter if it's a public listed company or not, means the shareholders or the business owners, this group of people would like to know whether the company is profitable, whether they can pay the dividends to the shareholders or to the owners, whether they can make profit from it. So they are concerning about the business, how well is it running, and whether the company can pay them the dividends, because for those investors, they are looking for the returns from the company. And next, the managers. The managers, they are working with the company. They are interested in the company's financial situation so that they can plan effectively for the future. In other words, they are responsible for the financial performance, those group of managers, so they need the financial information for them and to check whether they can meet those financial targets and objectives. If yes, that's good. But if no, they need to think how effectively or how effective they need to work so to achieve the financial results or financial goal. For the banks, they may wish to see whether the business can afford the repayments on loans and overdrafts. And in some cases, the banks need to read through the financial statements or the audited financial statements before lending money to any organizations or any business organizations, because the banks, they are conservative. They have to ensure the money can get back, can be returned from the borrower. So they need to check the financial statements in order they can make sure it. Or after the company is borrowing money from the bank, the company need to send the financial statements to the banks on a regular basis to make sure its ability to repay the loan. And next, employees. They are part of the company and they are interested in the financial position. That means whether the company has sufficient cash, for example. So they would like to know more about the financial position of the company and the impact this will have on the jobs and wages. So for employees themselves, they are working for the salaries and they are looking for better career prospect as well. But they would like to know whether the company can pay them the salaries on time, and whether the company can ensure the career path for them, because if a company has any issue, say a risk of bankruptcy, then the employees they are not happy to work with it. For the suppliers and customers, they would like to read through the financial statements because they may wish to check the financial stability of the business to ensure it will be able to make payments, supplies goods as needed. One example is about the equipment or the expensive equipment. The supplier can sell the expensive equipment to the customer, but the requirement is they need to check the customer's financial status or financial conditions. They need to read through the audited financial statements from the customers so they can assess whether it can have the ability to repay or to pay them for the expensive equipments. And the final party here, which is also interested in the financial statements, is government. They may wish to check that the business is obeying the relevant laws on reporting and taxation. And in many countries, the companies must send a copy of financial statements to each of their shareholders at the end of the year. Also, for them, they need to submit their audited financial statements to the government under the local law or the regulations. So as said, companies must send a copy of financial statements to their shareholders, and for large and publicly quoted companies, they are also required to appoint external auditors each year to give an independent opinion on whether the financial statements have been drawn up properly and whether they give a true and fair view. For true and fair view, we will go through it by details in another class about the audit, because it's from the auditor point of view whether the financial statements is true and fair. Because from the auditor point of view, they don't say it's accurate, because they cannot do every investigations on every transactions. So we have one in-class question for this class. This question is about a company called Noah. Noah has been asked, Noah has been asked to find 4 pieces of information about this company, FGH Limited, for his manager, from the company's statement of profit and loss and the statement of financial positions. There's SOPL and SOFP. He has been asked to find, first, the ratio of current assets to current liabilities. Second, the total shareholders' equity. Third, gross profit as a percentage of revenue. And fourth, total rent expense for the year. Which of the following correctly match the information needed with the financial statement each would be found in? So remember, we have 2 financial statements, statements of profit or loss and statements of financial position. And for statement of profit or loss, it details the income and cost incurred for the period. So you have to remember, other than income and cost, they should not be found in the profit or loss account. They can be found in the statement of financial position. And here, you have to ask yourself whether current assets, current liabilities, are these grouped under income or cost? Seems not right. So it shouldn't be in the statement of profit or loss. And then shareholders' equity, is it income or cost? Seems not. Gross profits and revenue, yes, is income. It should be grouped under income or cost. And for the rent expense, it's quite clear that it's under the cost item. So based on the analysis, you can pick the right option here from A, B, C, or D to answer this question.